Good evening, everybody. Thank you so much for joining us this evening. In the light of a new budget, there is an appropriate time to review the Indian and Australian income tax in total. And we hope that you can make the most out of this session. We have received a lot of interest for this webinar, which is highlighting the relevance and complexity of this topic. Just to give you an overview of this program, in the first 20 minutes, I will be talking about 5 tax mistakes to avoid when selling in Indian properties with a new budget is in place. Then we have 10 minutes for Q&A. We'll extend it if there are a lot of questions. Please add your questions to the chat box and we will address them during the Q&A session at the end. At the outset, we have a disclaimer. This presentation should not be considered as tax advice. Please consult your tax agents, lawyers before proceeding further. We're sharing this information for everybody's benefit. Before I begin, I would like to give you a bit of context by telling you about how Nobilis NRI taxation was formed back in 2016. It started with my own experience of trying to bring funds into Australia. Despite being a chartered accountant and CPA Australia with an international taxation background, I struggled to navigate through the maze of tax rules in India as well as in Australia to bring funds. It was a stressful process. It is too complex, no set process, and no standard format. Indian CAs don't understand Australian tax rules, and Aussies accountants don't get the Indian tax rules. I realized I had the skills and expertise to help others in a similar position. And after 8 years of dedicated efforts from my amazing team in Bangalore and Sydney, we are here today. Mangala is the director and head of operations in India. And Pranati is a chartered accountant with many years of an experience in PwC, having a great insight into an international taxation. And Neeraj is an Australian ITR expert who worked in Melbourne for a few years. Okay, let's start off. For the following few slides, I'll be describing in detail the 5 tax mistakes to avoid while selling Indian properties and repatriating the funds to Australia, and the recent changes in the budget. There are not much changes to the tax rates. However, a lot of changes in tax administration. And I'm just highlighting my viewpoints here that income tax collection has doubled. The tax filings have doubled without increasing the tax rates. Recently, NRI clients got tax notices under Section 148 as well. There's a lot of follow-up from the tax office, and let us see how we can manage the taxes to avoid all of those and stay compliant. As you may see, the ultimate objective is to bring funds from India to Australian bank account after selling an Indian property. How do we do it? We have few hurdles to cross before reaching the happy moment of having funds in our Australian bank account. Let me start with the first one. Should you disclose an Indian property sale in Australian tax return? So anybody has any suggestion on this? Please let me know. Let us see who has to disclose. Why do you need to disclose and what needs to be disclosed. I understand and empathize that many individuals may not have included certain details due to the lack of clarity and confusion surrounding them. In some areas, it is not entirely clear, but when it comes to disclosing this information and capital gains in the Australian income tax return, it is essential to adhere to the Australian tax law. And it can be challenging to accept the fact that you have already paid a taxes in India on the capital gains and haven't brought those funds to Australia. However, Australian tax law is very clear on this matter. It must be included in your Australian ITR. At our firm, we have been assisting our clients in properly disclosing this information and utilizing the various tax planning strategies to manage and meet the required tax obligations. It provides a peace of mind knowing that you're doing the right thing and avoiding penalties, especially when ATO or AUSTRAC eventually conducts a data matching. Compliances in India has increased dramatically. ATO has already started sending notices to an Indian income not being included in the Australian tax return. So just to recap, what I've just explained it to you, the permanent residents and citizens needs to include the global income, including the capital gains. It's also wrong to assume that if you don't bring the funds to Australia, we don't have to disclose it in Australian ITR. Let's look at the second important point, the financial year in India and Australia. Financial year in Australia starts from 1st of July to 30th of June, but in India, the financial year starts from 1st of April to 31st of March. It is advisable not to sell a property in April, May, June because of overlapping financial years. For example, if you sell in April, you will have to wait 24 months literally to get the compliances done for all of that. So if you are planning to sell a property, try and sell it before 31st of March, and which is ideally suited for the Australian permanent residents and citizens. And it is better to sell during December and January based on our experience. Anyway, we have already passed January now. The third important one is not doing an Australian tax planning before the sale. Planning the Australian tax return beforehand will help you minimize the overall tax liability, both in India and Australia put together. As you are aware, such transaction can have a significant tax implication, both in India and Australia. I believe it is crucial for us to engage in a proactive tax planning before these sales occur to ensure you can maximize your savings. It is very helpful in the case of investment properties or inherited properties. Tax planning is a very powerful tool that can substantially reduce your tax liabilities in both countries. As we discussed earlier, as an Australian, you have to pay a tax in Australia for the Indian sale of shares and properties, irrespective of funds reaching Australia. By strategizing ahead of a financial year, we can explore various lawful avenues to minimize the taxes you owe. This might include timing of sale or taking advantage of dual tax exemptions or a deduction and other strategies tailored to your unique situation. It is important to note that our option to optimize your tax position significantly diminishes once the financial year concludes. After the year end, our ability to influence the outcome of your tax liability is limited, and we will be primarily focusing on compliances with the ATO rather than a tax saving strategies. I would request everybody to reach out before 31st of March if you have already planning to sell the property or have sold the property. Just to give you an example, reinvestment your funds, let us say 50 lakhs in the bonds in India, does not attract capital gain tax in India. This option may be suggested by a chartered accountant in India who may not be fully aware of the Australian tax rules. This is where our capability lies. We take care of your India compliances, Australia compliances, and bridge a gap where we will find the maximum tax planning for you. This tax exemption is not recognized in Australia, as you may have to declare it in Australian ITR and end up paying a little bit of more taxes. We can assist you with our customized tax minimization strategies by which 60 to 80% of our clients don't end up paying any taxes in Australia for the property sale. The property sale in India need to be disclosed correctly. In our tax advice report, we consider your tax liability, cash flow requirement to suggest 4 different options for you to choose from to minimize the overall tax. We also consider visa conditions and rules, date of permanent residency, citizenship, and date of purchase to apply a tax minimization strategy. Lower withholding of taxes. There is a TDS of 20% on sale price. Lower withholding of taxes improves your chance of getting funds faster. If you have already given a deposit or required a funds immediately, this is very helpful. It usually takes 6 to 8 weeks to do this, and it's a good idea to touch base with us well in advance of your planned sale. NRO account, PAN, and a KYC to transfer funds to Australia. These are basic documentations needed, and funds get stuck in India because of something simple like not having an NRO account. And a PAN, you need to be updated with your current status. A lot of NRI clients' PAN were deactivated recently. I will just give you some tips at the end about how to be compliant, how to stay out of trouble. KYC is another thing. Please make sure KYC is updated with your bankers. What do you need to repatriate the funds? In most cases, funds are deposited into NRO account. And how to avoid a 20% of withholding taxes? Need some kind of tax planning there. And how much can you transfer? Usually 1 million USD you can transfer without having to go through a lot of documentation. That means $1.3 million, which you can transfer easily without much documentation. Let us come to the very important point. This is one of the highlights of a budget, the CA certificate under Section 15 CA and CB. Most of the repatriation of funds needs a 15 CB now. And they have smartly changed the rules there, and the bankers are not taking any risk, and they end up asking for repatriation. What are the action points you might have to do to post the Indian budget? So how do we avoid non-compliances? How do we stay ahead of compliances and not getting into any trouble at the future? So I have summarized everything in the to-do list. Make sure PAN is active and linked. Check your income tax portal. Ensure nothing is pending, no notice or a no demand for taxes. Find out whether you have lodged your tax return for the earlier years. And the bank account is updated with a KYC and converted into an RO account, not a saving bank account. TDS deduction in India is not a compliances. In the most cases, you need to lodge your tax return. What are the simple things which you need to do in Australia? Disclose every Indian income in your tax return and disclose your assets above $50,000 in the Australian tax return. At last, that happy moment is here. Your funds have landed in an Australian bank account. At the end of the presentation, we offer advisory services to maximize your taxes benefits and assist the clients in challenging situation in India and abroad. Additionally, we have a network of professionals who can help you with an Indian property purchases or assist in selling and repatriating the funds to your Australian bank account. You will get a high quality advice from us on time, every time. We also have a network within our client base, who are looking to buy in Indian properties. If you are looking for a buyer for your Indian properties, we can certainly assist you with that. Alternatively, if you have already found a buyer, we can help you with the sales and repatriation process. Best to reach out to us at least 8 weeks before the sale. All our partners have a good understanding of a requirement of an Australian and permanent residents and citizens selling properties in India. You will be in safe hands. Our vision is to offer a one-stop solution to sell your Indian property and bring funds here and build your real estate investment portfolio in Australia. We offer peace of mind with a lot of hand-holding from our Indian team and a value for service. This will reduce your uncertainties in this process, and your funds are going to come to Australian bank account. Thank you very much. Just write to us at info@nritaxation.com.au or WhatsApp us. We will help you to take it forward. Please add your questions to the chat box. Thank you.